Welcome back, WSU Vancouver VITA volunteers. In our last lesson, we covered the standard deduction, and we also covered the extra little deduction for charitable contributions for our taxpayers who are still claiming standard deduction. And then we found ourselves at the bottom of page 1 of the 1040 with taxable income, which allowed us to flip over the page to page 2, and we talked about how the tax computation is done by TaxSlayer. So today we're continuing on with page 2, and we're going to lump actually 2 lessons together in this slideshow. So we're going to be talking about credits for children, so that's the child and dependent care credit, as well as the child tax credit and the credit for other dependents. So I just want to make clear, when you go on to Link and Learn, there's a separate lesson for the child and dependent care credit, and then the child tax credit and the additional child tax credit and the credit for other dependents are together as one lesson. So that's how those lessons are divided out when you go over to Link and Learn. Let's begin with the child and dependent care credit. And this is one of those credits that had a lot of changes, a lot of temporary provisions for 2021. So the credit used to have some different rules, and for 2021 those rules were expanded and made a little more generous and friendly. But we're not necessarily expecting them to continue with these new rules unless there is some new tax law or extensions made. So we would be expecting them to be different for this year, and then in the coming years they would revert back to the usual rules. Now, it's certainly possible that extensions could be made, a new tax law. Certainly last year, we had a lot of changes right up into the filing season. So we'll just kind of stay tuned and keep in mind that, you know, things change as we move along. So to kind of get us started, let's talk about how the child and dependent care credit originally worked. So you would be able to receive as a credit towards the tax due an amount of 20 to 35% of what a taxpayer might have paid in qualifying expenses for dependent care. And they could claim up to $3,000 for one qualifying person in expenses and up to $6,000 for 2 or more qualifying persons for those expenses. And the credit used to be non-refundable. Now, for 2021, things are a little bit more generous, as we talked about before. So now taxpayers can get a credit of up to 50% of the qualifying expenses that they paid. And they can claim, instead of $3,000, up to $8,000 for one qualifying person and up to $16,000 for 2 or more qualifying persons. And in addition to that, this credit is now going to be refundable for most of our taxpayers. So in order to claim this credit, there are going to be 5 tests that our taxpayer has to pass, 5 hurdles. So there's the qualifying person test, there's the earned income test, the work-related expense test, the joint return test, and the provider identification test. So let's kind of take these one by one and see what they mean. Our qualifying person test refers to the person that our taxpayer is trying to claim they had expenses for. So there's kind of 3 categories. one category is a qualifying child. And this qualifying child needs to be under the age of 13. They need to be claimed as a dependent. And if this is a situation where we have divorced or separated parents, this is not one of the credits that can be transferred to the non-custodial parent. Only the custodial parent can claim this credit. And they can still claim the credit even if they have transferred that dependency to the non-custodial parent in that year. The second set of people who qualify as a person for this test are people who are physically or mentally incapable of self-care. Again, they would be claimed as a dependent. And if they are not claimed as a dependent, the only reasons why they were not claimed were due to the gross income. So if you remember, we might have a qualifying relative who has a gross income of, well, they would have qualified for qualifying relative, but their gross income was too high. It was over the $4,300, in which case our taxpayer wouldn't be able to claim them, but they would still be able to use them as a qualifying person for this test. Again, the same idea if the person is not able to be claimed because they are filing a joint return with somebody else, or the taxpayer or a spouse is a dependent. And this is a sort of a situation where you might think of like a parent, where somebody is paying for care of a parent. Another group of people are a spouse. So as you recall, you can't ever claim your spouse as a dependent, but you might be able to use them as a qualifying person for this credit if, again, they are physically or mentally incapable of self-care and they lived with the taxpayer for more than 50% of the year. So then we move into the earned income test. And in this case, the taxpayer and the spouse, if they are married, must both have earned income during the year. And so for the purposes of this credit, earned income includes wages, tips, salaries, other taxable employee compensation, net earnings from self-employment, and disability pay reported as wages. If the spouse is a full-time student or if they are unable to care for themselves, then $250 each month for one qualifying person can be allocated as income for that spouse. Or if there's two or more qualifying persons, that amount that gets allocated as earned income would be $500 each month. So let's shift our attention now to the expenses. And the qualifying expenses need to have been work-related. So they need to have allowed the taxpayer and spouse, if married, to either work or look for work, or in the case of a full-time student, that counts as well. The expenses also need to have provided for the qualified person's well-being and protection. So if we look at what that means, expenses could include preschool or home daycare for children who have not yet entered kindergarten. After they have entered kindergarten, it would be before or after school care. In the summer, it could be for a day camp. In the case of more often thinking about like a spouse or a parent, it could also be amounts paid for a housekeeper or a cook if at least part of the expense was for the well-being and protection of that qualified person. So things that it does not include are education expenses for children who are kindergarten and above. So For instance, after school care counts, but if you are hiring a private tutor after school, that does not count as a qualified expense for this credit. And additionally, while day camp would count, an overnight camp would not count. The joint return test says that married couples must file joint in order to claim the child and dependent care credit. The exception is for persons considered unmarried, which we talked about before in our filing status lesson. Under certain situations, a married person would be considered unmarried if they haven't resided with their spouse for over 6 months. And usually in that case, the reason why they're considered unmarried is so they can file head of household. Just kind of the general rule of thumb with this credit is if they're married filing separate, they cannot claim this credit. And our last test is the provider identification test. And if you remember, we talked a little bit before about the income matching program that the IRS has. And so this is kind of part of that. So if people are claiming this credit, the IRS wants to know some information about the provider who should be claiming the income. So the things that we need to have in order to claim this credit are the name of the provider, the address, and the tax identification number. So that would be like a social security number if this was an individual, or an employer identification number if it's a organization or facility. At this point, we're moving on from that first lesson, which was just the child and dependent care expenses, and moving into the second lesson for purposes of Link and Learn and Publication 4491 that covers the child tax credit and the credit for other dependents. So with the child tax credit, again, we have a lot of new temporary provisions for 2021. So let's talk a little bit again what the credit looked like before and then what it looks like for this year. So before, the child tax credit was for qualifying children under the age of 17. So if at the end of the year they were 17, they would not get this credit. And then it was for up to $2,000 per qualifying child. And it was claimed at the time of the return. So, you know, people would get this money back in with their refund. It was partially non-refundable, with the child tax credit part of it was non-refundable, and then part of it could be refundable through the additional child tax credit or the refundable part of the child tax credit, but officially it's called the additional child tax credit. So in 2021, tax laws were adjusted, so now the child tax credit can be claimed for qualifying children, including the 17-year-olds. And for children under 6, the credit amount was raised to $3,600. And for children 6 to 17, it was raised to $3,000. And you probably have heard in the news, maybe, maybe not, might be depending on whether you have children, half of it may have been paid in advance. For the most part, it was paid in advance unless people went onto the IRS website and opted out of that. It's also possible that if they had a new child in 2021, they may not have gotten all of their advance credit. And then this year, instead of being only partially refundable, it may be fully refundable. So let's talk about who these qualifying children are. So if you'll remember back when we were learning about dependents and qualifying children and qualifying relatives, a lot of the same tests are going to apply for qualifying children for dependency as for this credit, but there's a little bit of difference. So for this credit, we again have the relationship test. So, you know, son, daughter, stepchild, foster child, brother, sister, half sibling, step sibling, or a descendant of any of them. It's our age test that's a little bit different. So if you remember, to claim as a dependent as a qualifying child, they need to be under the age of 19, or if they're a full-time student, under the age of 24. Not for this credit. For this credit, and for 2021, it's 17 or under. And then there's the residency test. So again, they need to have lived with the taxpayer for over half the year. That's the same as the dependency. And if you remember, there were the special rules for divorced or separated parents who lived apart. So the custodial parent is able to transfer this credit to the non-custodial parent. And then there's a support test. This again is the same as the dependency. It's just that the child did not provide more than half of their own support. Now, there's a couple of the other tests, I think the pre-qualifying tests for dependency that we had talked about. It's again just a little bit different for this credit. So in this credit, the qualifying child needs to be a U.S. citizen, a U.S. national, or a resident of the United States. So residents of Canada or Mexico are not able to qualify for this credit. And then they also need to have a valid social security number. So this is one that we definitely could run into in tax season. If we have a child that has an ITIN, they will not qualify for this credit. It has to be a social security number. Now, the child tax credit has always had some phase-out limits based on modified adjusted gross income. And we talked a little bit about that in our adjustments lesson. You know, you take your AGI and you make some modifications to it, probably some additions in, and that gives you a modified adjusted gross income, or MAGI. I'm not going to go into what all those modifications are. TaxSlayer will calculate this credit for us, but it is important to have an idea of some of the phase-out thresholds, so that, you know, if you are expecting to get the whole credit and you don't see it, you'll understand maybe, oh, it's because this person had just a little bit too high of modified adjusted gross income. So the new limits are a little bit lower than the limits had been in previous years for the child tax credit. So single or married filing separate, if they have a modified adjusted gross income of over $75,000, you're going to see a phase out of the extra amount that was put in place for 2021. And for head of household, that amount of MAGI is going to be $112,500, and for married filing joint, $150,000. So if they have over that amount, then those increased amounts, as I said, will be phased out until they get to the point where they would only be claiming the original $2,000 amount of the child tax credit, and they would be under the original rules where it wouldn't be fully refundable, it would just be partially refundable with that additional child tax credit. And those, again, have their own phase out. It's quite high, so I don't think we're likely to see that for any of the returns that we'll be preparing. But it's possible that we could see the phase out of the increased amount. So with taxpayers receiving 50% of this credit throughout 2021, so long as they didn't opt out, there's a little different process than there was in previous years. It's instead of just claiming the credit on the return, there's now a reconciliation process to make sure that they received the correct amount. They might be due a little bit more, or if they've received too much, they might have to pay some back. But it's important to note that for a lot of our taxpayers, they're going to be able to be exempt from having to pay back if they have a low enough income. So taxpayers should be receiving letter 6419 from the IRS that shows the amount that they received for the advance payments, and that will need to be entered into TaxSlayer. We don't yet have the 2021 software, so I'm not sure where that will be yet, but there will be an entry for it. If you look at the form or the Schedule 8812, which is for credits for qualifying children and other dependents, it's grown quite long now. It's 4 pages, and there's a line on there that says enter the aggregate amount of the advance tax credit payments, and then of course it takes you through an algorithm that figures out, you know, whether this taxpayer received the right amount. Again, TaxSlayer is going to do the heavy lifting on these calculations for us. We just need to be sure that we are checking with our taxpayers that they have this letter if they have children and are claiming this credit, and that we are entering it into the correct place in TaxSlayer. Now, there are a lot of dependents that don't qualify for the child tax credit. Certainly, we have our qualifying children who are over the age of 17, and we have our qualifying relatives. In that case, there is the credit for other dependents. And in order to qualify to get the credit for other dependents, the dependent must be a U.S. citizen, a U.S. national, or resident of the U.S., so that's the same. But we have a little more room with the tax identification number. So in this case, they can have a Social Security number, but they can also have an ATIN or an ITIN. The credit's not quite as generous as the child tax credit. We only get $500, and it's non-refundable. So if our taxpayers owe less than the amount of credit in tax, they only get up to the amount of tax that they owe, and then anything above and beyond that is just lost. So it's not quite as generous. They won't be able to get more refund than what tax they owed on this credit. I wanted to finish up by looking at the 1040 again, and we're on page 2 again. And if you'll remember our last lesson, we stopped off with line 16, which was the tax. And the next couple of lines are adding in a little extra if there's other taxes that need added in. For this lesson, the first line that we're looking at is line 19, non-refundable child tax credit or the credit for other dependents. So remember that was non-refundable. So the next few lines take us through a process where we can subtract the amount of non-refundable credits from the tax down to 0. But you can't subtract and get a negative tax number at this point, or any kind of extra refund. It can only take the amount of tax that was calculated from taxable income down to 0. But you'll notice that down a little further, we have our line 28, which is where the refundable child tax credit or the additional child tax credit shows up. So if you remember, our child tax credit this year may be fully refundable for a lot of our clients, or if their income was a little higher, it may be only partially refundable again. And in this case, it's a little different. Our taxpayers' tax could be subtracted down to 0 and then beyond. So if they have more of these refundable credits than they had in tax, then they would get a refund and they would be able to get more back than they would have had due based on their taxable income. So now that we've discussed our credit for child and dependent care expenses, and we discussed our child tax credit and the additional child tax credit, and we discussed the credit for other dependents, here's what I want you to do. I want you to head on over to Link and Learn and answer the skills check questions. Remember, this slideshow covered 2 lessons. The first was the credit for child and dependent care expenses, and then our child tax credit and credit for other dependents were lumped into another lesson. So together these lessons, there's 3 skill check questions each, so together there's 6. And then I want you to go ahead and enter child care expenses into the appropriate practice return on TaxSlayer. And as always, we have our publication 4012. Publication 4491 is where all this information came from. And again, the IRS just recently released our 2021 versions of these. You use the same link and you'll just notice on the cover that it says for 2021 returns. So a lot of these new temporary provisions for 2021 are now covered in the materials. And you can look at those to get any extra information or reminders about that.